Today we're switching roles. How can you improve your investor skill by learning from somebody else's journey?
Fellow investors, bonjour. This is Mike Leroux, founder of Dividend Stocks Rocks and passionate investor. You're listening to the Dividend Guy blog podcast where I and my co-host Veronique will help you invest with more conviction so you can enjoy your retirement.
Dividend growth investors, bonjour. Mike Leroux here. You're listening to the Dividend Guy podcast, but today it will more likely be the Vero podcast, isn't it, Veronique?
Yeah, well, Mike, I'm very excited, but also a bit nervous because, like you've said, today's episode is me answering questions, and I've seen some of your questions, and it's gonna be tough. You didn't make my life easy.
Well, I mean, that's the whole point of like having those kind of discussions, right? I mean, if you're just here to say everything is cool, everything is peachy, and being an investor is perfect, well, it will be kind of a boring episode. So we did that last year, I think, mostly because a lot of our DSR members wants to know more about you. You've been present with us for so long. And I mean, funny story, but Veronique started working full-time at Dividend Stocks Rock before I was working full-time on my own business. So she's that kind of person who's ready to take a leap of faith. And a few years ago, you decided to finally started investing on your own. So my goal with this episode is really to learn a little bit more about that journey and what made you invest on your own, finally decide to use DSR tools, but not necessarily just say, oh, DSR tools are amazing, but I just love the fact that sometimes we can learn from just others, investors like us that face the same struggles, face the same challenges. So before we start with all the questions, I want to thank Sophie Andrus, DSR member known as World Writer, and other DSR Pro members that sent plenty of questions today. So we had to kind of make a good list to cover most angles. So we're going to start by setting the table and maybe some people that doesn't know you, who doesn't know Vero, but I mean, that could happen, right? So how would you describe yourself? Tell me a little bit more about your background.
All right. So first of all, maybe you don't know that, listeners, but my real name is Veronique. I'm French Canadian, so Veronique. But it's so hard to say in English that we always go with Vero. I've been happily married since 2010, and I'm also the mom of 3 beautiful children, Xavier, 13, Remy, 10, and Alice, 8. I'm passionate about horses. I think I've mentioned that a couple of times. I also earned my bachelor's degree in communication, and I've worked in marketing since. I have been working with Mike since 2010, actually, and I was, like he said, the first employee at Dividend Stocks Rock. And I was working alone and feeling a little lonely at first, but then it grew up, and I'm really happy to still be there.
Yeah, and to put that into perspective, let's just say that I started working full-time in 2017. So it took literally me 7 years where Vero was working alone in her office, doing plenty of different things, but that was quite a journey. Now, I would like to know if you have any books or podcasts or any other resources that has an impact on you recently.
All right, so maybe it's a shame. It might be a shame, really, because I'm here doing a podcast and I don't listen to many podcasts. Also, when I read books, most of the time they're thrillers and crime novels, and my family makes fun of me because, I don't know if you ever saw me, listeners, but I have blonde hair and light eyes and all that, and people don't have this image about me, but I really like crimes and murders and all that stuff. So hopefully it doesn't have much impact on me.
You know, there are a lot of true crimes podcasts. Maybe you should start listening to those.
Maybe, but yeah. So I'm not like a regular podcast listener. Sometimes I grab like an episode here and there when I have a question, when I have like a special project in mind and stuff like that. But I listen to a lot of music. That's like what I enjoy the most. However, I get a lot of inspiration from the people around me. That's where I'd say I get the most impact on my life. You, Mike, are one of them. Actually, you showed me through the years that it's possible to plan as if there were no limits. You always look to reach the next level. So every time it gets me thinking on my own, like, what would I accomplish or what would I dream of if there were no limits? And it kind of pushed me elsewhere and help me try new things. So that's really something that impacts me a lot. Then my husband had such an impact on my life in general. But one example I could say is that he never stops training. He's always taking care of his health. And people could think that it's physical, but actually it's a lot like mental health because when he doesn't, he's not in a good mood. So looking at him brought me to like do spinning every morning, go back to horseback riding lessons, and actually it made me put myself in priority sometimes and take time for myself. So it's directly linked to one of my dearest goal, which is to be able to ride horses at a very old age, like past 80. I want to be sitting down on a horse and ride.
Wow. Well, I can tell you up front, your sister would not do that. She would
No,
be
but
scared.
my sister, that's like the third part I wanted to say. I also have like some couple dear friends, and my sister she's my sister, but she's also a friend, is part of that. Like I could mention Isabelle, Audrey, and Jose. All three of them always have like new projects in mind. They all went back to school in their 40s. They started a new job or a totally new career. Audrey is getting married soon. I mean, they are always getting out of their comfort zone, and I really admire that. So all of those people have pushed me to make my biggest dream come true in the coming years, and I have talked about it to you, but I really want to own my own horse in the coming years. So more to come about that.
Yeah, definitely. I'm pretty sure it's going to come quickly now.
Yeah, so investing for me is more about having the lifestyle that I want. It's a means to realize some dreams without worrying too much about retirement, future, kids tuition, and all that. So that's pretty much like the goal.
So before we get into that investment part, I'd like to know, like, what's something people would be surprised to know about you?
Okay, so it's kind of ironic, but I hate math and I don't like numbers.
We're gonna have a discussion after this podcast, Vero.
Also, fun facts, like random facts. I drive too fast most of the time. I used to be very touchy and impulsive. That I'm sure you remember. I've worked a lot on these negative traits, though, since I know my husband, actually. So, see, I love fall. That's my favorite season. I love snow. You don't. And I
We had
love
so many
animals.
discussion about this. It's just crazy.
Yeah, I love animals too. So I've mentioned horses, but I have 2 dogs. I have 4 hens, and the list could go on if my husband wouldn't stop me. I like all of them, pretty much.
All right, so I really have to stop you there. I mean, you hate math and you decided to invest on your own. Like, what brought you there? I don't get it.
Okay, so following you, of course, and other investors at DSR, I realized that it didn't have to be that complicated. What I don't like about math is like all those complicated calculations and all that. I hate it. And I also came to the conclusion that over the years, following you, reading your newsletters and your articles and all the stuff that we had at DSR, I gained a lot more knowledge. So I felt more equipped with DSR by my side, especially once we launched like all the pro dashboard and comparison tool and all that stuff. That I really gained confidence with those tools. So that's
So
why.
what you're saying is, instead of being a math nerd that will go inside the financial statements, run those calculations, and find the exact answers to those questions you ask yourself, is you found ways, you found tools to compensate for that lack of interest into math, but still you wanted to invest on your own, and you were able to find that over the internet. And I think that is like one thing that is great. And of course, we're talking about DSR because that's our membership website. But what I found very interesting today is, regardless of your investing strategy, you will be able to find enough resources on the internet, like either on YouTube or like listening to podcasts, or just like subscribing to newsletters, that you will get that knowledge and that confidence to build your portfolio on your own and skip on like thousands of dollars in fees every year that an advisor would charge you. And that would have not been possible like 20 years ago.
Not at all. And I mean, like, who doesn't want to make more money? That was the starting point was that I was like, I was following you and other investors, and I was like, how come I can't do that myself? How come I can't like improve our financial situation? That was like the starting point, and then it took me a lot of years to gain confidence, but I made it.
Yeah, it's good that you just did it on your own pace as well. So switching over, like, what are some of the proudest moments you've shared with me and with DSR since you started working alone and then working and being part of a team?
Well, Mike, we've known each other for so long. There are so many things I could share, both on a personal level and professional. But I'll keep it professional for this episode.
I don't have to do any editing.
I mean, the list could go on. Even like I said, I started working with you in 2010, so it's been a long time, and so many things have changed. But I'd say that our 10th DSR anniversary last year was when we realized how far we have gone, what a solid resource DSR is for investors, and how we had built like this amazing community of investors. And I remember that we both kind of shed some tears at one point, and I mean, it's common for me to cry, but it's not for you. So it's definitely something I'll remember.
And it's on tape. On top of that, we do like, I remember that webinar where I was not able to speak anymore. And yeah, so that recording will be live forever now.
And I could also add the creation of this podcast because it was something to me. I would never imagine doing a show in English about investment. Like, those two put together was definitely not part of my plan. But it's a great gift. And listeners, you might not know this. Mike and I are both involved, but I'm pretty much in charge of this show. And it's like my baby at DSR. And I think that you are probably as proud of that as I am.
Yeah, and it's good also because this year we're moving on another level where we're not going to talk too much about it already, but the podcast is going to evolve a little bit, and you're taking another like bigger step into that journey. And I just want to say that I'm like very proud of that as well. So that's really cool. So now let's get into the nerve of this podcast with some like more question geared towards investing. So first, let's start with, what is the investment advice or principle from Dividend Stocks Rock that you find yourself relying on the most in your investment process? So what is like the most important piece of advice that you got from DSR that resonate with you when you invest?
That's the dividend triangle for sure. I mean, there's no doubt about it. I only select stocks with ratings of 4 and above. And I mean, ratings can mean nothing, but at DSR, ratings of 4 and above means that those companies show a strong dividend triangle. And like I've said, I don't like math so much. So it's simple, it's efficient, and this is exactly what I need. And it also makes sense to me that, growing revenue, growing EPS, and growing dividends will lead to thriving businesses in their industry. I'm just 100% sold to this.
And I mean, it makes things a lot easier because, and even myself, sometimes when I have like questions on the webinars and it's a company I don't know that much, I will start by looking at the dividend triangle and trying to figure out if it's a company that I should know or not. And rapidly, if I see a business that shows no dividend increases and struggling revenue growth and earnings that are quite hectic, well, then you already have like a pretty good of part of the answer where, well, if you go into this one, you have to take a bet or you have to know a lot more about the business to be confident in that investment. Well, it could be a lot easier in just looking for companies that are thriving and just narrow down your list like this. So how's your investing style or investing strategy has changed over the years since DSR? And maybe most importantly, like when did you start investing?
All right, so it took me a lot of time. You probably have guessed it. So DSR changed everything. For years, I thought I didn't know enough to be a DIY investor. So before DSR, as simple as that, my investing strategy was non-existent. Like it was nothing.
That's pretty simple, right?
My husband was the only one investing through his pension plan and RESP and mutual funds. So we were very far away from dividend stocks, dividend growth stocks. So dividend stock, like I said, has slowly but surely given me self-confidence and the tools that I need. So I started building my portfolio in 2021. That's like just 3 years ago.
Yeah, but during those 3 years, I mean, you were fortunate enough to go where, in 21, making money was super easy. 22, you probably took a big hit. And then 23, 24, a lot more uncertainties started to rise. So I guess you got tested a lot more than many investors. I remember, I mean, between 2009 and 2019, those were like relatively an easy decade, if I could say. But over the past few years, it seems that like the landscape is changing very quickly. So today, what does your portfolio look like?
Okay, so as of now, I was able to invest in 20 different stocks in 10 sectors. My top 3 sectors are information technology, consumer staples, and financials. My biggest holdings are Microsoft, National Bank, Alimentation Couche-Tard, oh, surprise, Apple, and Granite REITs, a frustrating one. And also, I was surprised to see Granite in the top 5, but from top 5 to top 10, the weight is very, very similar. And my biggest winners so far are Microsoft, McDonald's, Couche-Tard, Apple, and National Bank. So yeah, and
completely unrelated to this show.
And doing this small exercise for the episode made me realize that I will need to rebalance a bit at the end of the year because Microsoft and National Bank are getting like a bit heavy these days. So that's pretty much it. And I find it interesting that, like you said, those years were not so easy on the market, and my portfolio is still up and growing despite like those mistakes that I made and sold at a loss. So I'm still confident that numbers will improve as I learn and make less mistakes.
We're going to go into those mistakes, but just before, I have like a few questions that just pop up in my mind. So you said you have like 20 stocks in 10 different sectors. So my first question would be, out of curiosity, what is the sector you did not invest in?
Energy.
Energy, okay. And across your positions, you said, well, Microsoft and National Bank started to get a little bit too heavy. Most of them are relatively about the same. So do you have like an approach where you're trying to have, we often talk about like an ideal position, so a specific weight for a stock, or like did you try to get at first like 20 stocks with roughly like 5% each? Is this the way that you build the portfolio at first?
Yeah, I was trying to have pretty much equal weight, but I wanted to have like maybe less weight in utilities and REITs because with interest rates and all that, I knew that it would be like rough years ahead, but I still wanted to have a little exposure. But yeah, Microsoft and National Bank, and also like recently I sold some Kushtar for the same kind of problem. They grew too fast, and I am on a drip plan because my portfolio is still young. So
Hmm.
with dividends and all that, that is why they grow bigger than the others.
That's interesting that you decided to put your portfolio kind of like on a automatic pilot where you don't have to think too much. You get the money from your dividend. They're being reinvested in stocks that you already research and that you feel comfortable with. And do you have any plans to go above 20 stocks, or do you think that that's enough? I mean, you're already covered in 10 sectors. You're like, of course, well diversified across all of those investments. But I'm just curious, like, are you are you continuing to look at for like new candidates for your portfolio, or do you just happy with those 20 companies?
Currently, I'm happy with what I have because, like I said, I really focus on, to me, top quality companies with high ratings at DSR. So at some point, I mean, there's a limit to like ratings of 4 and 5 that you can have. But I'm not like, I'm still open to discover maybe new opportunities, but I don't think I would go much higher than maybe 25, 30 at some point. But I mean, 20 seems like comfortable for me to review and keep in touch with what's going on.
Yeah, and I think I want to highlight that because it's an important point. When you run a busy life, I mean, you're still working full time. You have 3 children. You have like a farm in your backyard, literally, and now you want to, on top of that, have a horse, and sometimes you have to talk about your husband too. So, so with all of this, of course, trying to monitor like 50 stocks would be a bit unrealistic unless you're a math nerd, which you're not. So in the end, I think you're making it a good choice, but I just wanted to highlight that there are different ways to manage a portfolio and to build it, and finding one that makes sense to you and it's logical to where you are in your life. So maybe at one point children will grow up and you will have more time, and maybe you're going to
Mhm.
grow more interest into specific companies, and then maybe you're going to change your portfolio. But at this stage, I think you're making the right choice of trying to, yes, be diversified, but on the other side also minimize the number of time that is required to monitor that portfolio. So good job on
Right.
that.
Well, thank you.
Now that I've congratulated you over and over again, it's time to talk about mistakes, because man, we all do them. Like, why? I don't know, but we all have those skeletons in our closet, right? So we usually talk about mine, so I'm happy that we're not going to talk about mine today. How about yours, Vero? What's inside the rug? Well,
All
put
right. So
under the rug.
there are a couple of them, but I'll go with like the three biggest ones. So Silogist, 3M,
Mm-hmm.
and Bell. But I realized that they are kind of linked to the same error, which is relying too much on the story or being like in some kind of a bias. And I know you've mentioned that for yourself,
Yeah.
but for all three, I got seduced by the narrative and also biased by the long history, especially for 3M. And when the numbers kind of turned sour, I got confused. I was like, Bell is not gonna be that much in trouble. It's been there for forever. And same goes for 3M. And for Silo, this was just like so exciting. So I thought, I want to be in. But yeah, that was not, I should have looked at the numbers more at some point.
Yeah, and it's interesting that you highlight the fact that you had a very strong narrative for all of those three, and for the past 10 years, I think that has been my biggest mistake, because it's not that I don't know the numbers, it's not that I cannot do those calculations, but sometimes we just not necessarily just fall in love with a stock, but we're just like, oh well, the this has been part, like 3M was a dividend king. I mean, and for several years, I used to have it in my RESP for my children a long time ago as well. And I was lucky because I got rid of 3M before things turned sour, but it was more about the fact that I wanted to look for more growth. So it was not even like just thinking, oh, I was right about 3M and I got rid of it before I suffered. It was more about like, yeah, that went well, but I'm looking for something a little bit more like with growth perspective. And this one is like a giant that is like well diversified, but kind of like a GDP plus type of stock. So I just got rid of it and I got lucky. Never got into Bell, but I mean, I'm not too far away with TELUS these days, to be honest. And then Sylogist, well, we all know the story. And I just found it very interesting that people, and that's why I wanted to talk about that, is people will remember those mistakes, but they will not remember the rest of the story and the rest of your portfolio and your journey over there. So it just keep in mind, we cannot bat for 1,000. Sometimes we make mistakes. The point here is to make sure that you have more good moves than bad moves. And eventually that's going to like work out and going well. So before we did this episode, we looked at like the questions I'm going to ask you, of course. We prepared the episode and then we talked a little bit about the returns. And then I want to put you in a tough spot here because so far since 2021, you underperform a little bit versus ETFs in terms of total return. So do you think you made a mistake by selecting your own stock, since just buying like global ETF would have been better so far since the past 3 years? Or like, what do you see in the future for your portfolio? Do you have you second thoughts about managing your portfolio on your own?
Okay, so I know there's not much to brag about when we look at my returns. And I'm not gonna share them today because I'll explain why. The context here is important. I didn't buy all 20 stocks simultaneously due to the lack of money. So I bought 10 at first. I combined it with an ETF. Then it took almost 2 years to reach 20, sell the ETF. So if you consider that and the beginner's mistakes I made on top of it, my portfolio is still very, very, very young. It's like I just finished building it. So, and I mean, I also had like some bad luck along the way. I bought Nike not so long ago. It was still down from the previous year. So I thought it's going to go back up soon. And 2 months later, it dropped 20% more. And I mean, I know this company is not bad. It's just bad timing in this case. Actually, I'm still following it, but for now, it's not a bad business. It's just like the economical situation and, you know, all that stuff. So since I invest for the next decades and I really believe I select high quality companies, I'm sure it will pay off over time. So, you know, that's how I look at it. And besides, when I had the ETF in my portfolio, it was bugging me more than anything else. And I was really excited about selling it because sometimes it was down, sometimes it was up. I couldn't explain why. I mean, I was like, okay, the market in general is down, so that's probably why. But I couldn't dig in. It seemed like a waste of time because I don't have control over these stocks anyway. So I didn't like the feeling at all. This is why I will stick to my strategy of investing in dividend growth stocks.
and it's a really good point that you bring in, where and investing in ETF works. Of course, it works, but if you have a higher level of conviction in a different strategy, you're probably better off with it, because as you said, if you cannot explain what's going on with your ETF, if we go into a very bad market, which didn't happen since you started investing in 2021. I mean, 22 was bad, but it quickly recovered. So by the time that you were getting ready to get concerned a little bit, everything changes quickly. And then we just moved on saying, oh, the market is always positive. So not being able to have that trust in your strategy is crucial for the long term, because if you stick to a strategy, regardless if it's like momentum, regardless if it's going for value stock or for dividend growth stocks or ETFs with a global approach, if you don't stick to it, this is where you're not going to be able to reach your goal. As long as you're able to understand what you're doing and you do it for a very long time, it's going to work out. So kudos to you. And of course, timing, sometimes it sucks. And from time to time, it's just funny because some investors are just like, yeah, look at this stock. It's like thriving for the past 6 months. And I'm like, all right, but 6 months doesn't mean that much. I mean, I went into a similar roller coaster that you've been with Nike, with Starbucks. And when I bought Starbucks in 2017, I had to wait about almost 2 years before it fell into positive territory. So was not doing that well. At one point, it was like down double digit, and then it went up, and I was up like almost 100%, and then got bad comparable sales not too long ago, dropped by 20%. They changed the CEO, up 20%. So it's kind of like a mixed feelings here, but just to keep in mind, the market is highly volatile, and then sometimes one big news will change everything for a short period of time. And ironically, nobody tells me about Broadcom being down more than 10% on a single day when they announced the acquisition of, I think it was CA Technology in 2018. Nobody remembers that. Why? Because the stock has been skyrocketing as of late, and nobody cared about what happened in 2018 and on that day where they made a bad announcement, the market didn't like it, and the stock crashed at that day. Well, maybe in 10 years from now, we're going to talk about Nike, and we won't even remember why there's a small blip on the stock price graph that happened in 23 and 24. And this is how it works.
Listeners, I hope you enjoyed the episode so far, but I have to interrupt it a minute. Our goal at Dividend Stocks Rock is to help you invest with more conviction. We know that dividend income is important for you, and this is why we have gathered all you need to know about it in the Dividend Income for Life guide. Right, Mike?
Yes, I have a completely different approach when it comes down to generate dividend income, and I wanted to share my view with that. I wrote a series of DSR fundamental newsletters that were greatly appreciated by our members this year. I received tons of comments, and a lot of them were, Mike, you just came out with some very thought-provocative concepts, and at this point, I really want to change my portfolio and follow this path to a better type of dividend income. So I've did a great review of those DSR fundamentals newsletters, packaged them together, wrote a few more pages of content, and built that dividend income for life.
This guide, as you said, has been highly rated by our DSR members, and we share it for free with you today. To grab your copy, hit pause on your app, visit thedividendguyblog.com/income and enter your name and email. You'll then receive the email with your download. And also, by the way, it's always a pleasure to hear from you, so please let us know how it helped you. Again, thedividendguyblog.com/income.
Knowing all of that, knowing those 3 years, what you went through, the mistakes and everything, would you have done something differently?
Well, like you said, the market has tested me a couple of times already, but I know that my strategy works. So I think it is too soon to determine that I'm simply bad at making investment decisions. Maybe I suck. Only time will tell. But for now, what I can say is, you brought up that point in recent episodes, and it really resonated with me because you've said we've been too complicit. And I think I might have been too complicit and thought, this works. Mike does it, and then this member does it, and this podcaster did it too. So why not me? And besides, I mean, the market will go up and everything is fine. And so I skipped on some part of due diligence, and it led me to mistakes that were probably too heavy on a relatively small portfolio. I mean, I've mentioned Sylogist earlier. I owned Sylogist when I had 10 stocks in my portfolio. That was not a good investment for a young portfolio. Now I know it. I'm not going to
Yeah.
do that again. But,
Especially if you have like an equally weighted portfolio back then. So like a weight of like around 10%, that hurts big time.
it was not 10%, but still, it was just too big for the money that I had invested at that time. So, yeah, I should have looked at numbers and I should have not take anything for granted and assuming it's going to be fine.
So let's be honest with us now. Where do you think you skip due diligence? When does that happen? All the time? Sometimes? Most of the time?
Okay, so I know you're not going to be proud of me for that, Mike, because you keep repeating that part, but I don't spend enough time on my investment thesis. I pretty much rely too much on DSR for that part. I buy what our team says. Like, I'm like, oh yeah, that sounds interesting. And I realized over time that I don't mind fluctuations that much, like price fluctuations. I don't mind that, but I don't like educated guesses or speculative plays. They make me nervous. And also, while I get excited sometimes with the investment thesis and the dividend growth perspective and all that, I probably don't spend enough time on the risks and what could go wrong, basically. So, yeah, that's something I really need to improve.
And it's a mistake I noticed by talking with a lot of members, that they just say, oh, okay, so I'm gonna just like follow whatever is written on the website, and for the most of it, it works well, so that's good. But the point is not like follow, because the problem with this is usually we think we follow someone, we think we follow like a newsletter or whatever, like an other investor, but we don't follow that person or that website 100% on the time.
Mhm.
And this is where it creates a difference between, and I've discussed that a few times already, but when people mention Warren Buffett, but they do not copy paste their portfolio and make sure that it's exactly what Berkshire Hathaway has, they have it as a replicate in their portfolio. Well, you don't follow Warren Buffett. I'm sorry, but it's not the way it works. So while you do a part of it, but then just relying on somebody else's idea or research, for the most part, it's going to work out. If like we're relatively successful at DSR, we provide good information, of course. But the problem will happen where if you get excited, for example, with Silogist, and then you put like a 7, 8, 10% of your portfolio in a stock where I got excited too personally, but that was like 2% of my portfolio. So
Exactly.
And not just to turn on like I don't want to like to turn the knife here, but because I mean we all make those kind of mistakes. And I mean I doubled down on Algonquin when it went down, and that just hurt me even more than anything else. So that's why it's important to put more emphasis on that, where before, not after, before you press on the buy button, write down your investment thesis. Write down the reason why you like a stock and match it with financial metrics. If you're not able to get the financial metrics that matches your story, you expose yourself for some troubles. I mean, maybe you're going to be fine. I mean, I could close my eyes and pick up some stocks, and then some of them will do well. But overall, it may hurt your portfolio down the line. So I'm glad that you have learned quickly from those mistakes, because a lot of investors keep repeating those forever. And you seem to have learned a lot over just the past 3 years. So kudos to you, and kudos to like doing this interview as well, because it's not always easy. And of course, I mean, just to be fair, the portfolio is up, you're making money. It's just that you would have done better with ETFs so far.
Yeah.
Doesn't mean that it's going to be the case in 5 years from now, though. And the fact that you said you're thinking in decades, like, kind of tells me that you're going to do well going forward. All right, so 2 more questions for you. So a little bit easier now. Like that, we went through the tough questions. So, what part of investing have I failed you to convince that is fun?
I hate reading earnings reports. I find them boring. I get easily distracted. I prefer laundry over earnings report.
Oh
And
my
I
God. Okay.
hate doing laundry, so just to give you an idea.
Oh, that's tough for those people like doing those earnings report, trying to bring colors into those. I mean, some of them are really like dry and boring, but I can see that some marketing guys are trying to work on some of those reports to make them interesting. They will have to do a little bit more.
But you know what? This is why I really enjoy having my DSR Pro report because it highlights where I need to focus. It saves me lots of time on something I don't like. And since I cleaned up my portfolio and like I built and cleaned at in the same 3 years, but I mean it's all gonna be good in the future, I believe. But since most like of my holdings are highly rated and have top quality companies, bad news is not so frequent as of now that I got rid of the bad picks. So I mean, it's really it's such a useful resource, the DSR Pro report. And I know I sound like the marketing girl. I am, but it's not. It's the investor talking right now. It's not marketing. Hey, listeners, you have heard us talk about DSR so many times. I think it's time to invite you to join Dividend Stocks Rock and become part of our great community. At DSR, you can rethink your portfolio with our portfolio models, buy the right assets with our stock cards and stock screener, stay the course, grow your conviction, and get educated with our weekly newsletter and exclusive webinars. What else could describe this risk-free investment, Mike?
So in 2017, I took 3 major decisions. I quit my job at the bank, I decided to go full-time on DSR, and I decided to manage my portfolio account. So that pension plan was $108,000. I was about to invest it at a all-time high market, and thank God I had DSR tools to help me out. So over the years, I've built a platform to help investors invest with more conviction, giving them clarity and make it easy to invest and manage their portfolio. Fast forward today, this portfolio is now almost at $300,000, and it makes it so easy to just use a DSR Pro platform to manage a portfolio, buy and sell, and do everything within minutes.
And you know what, listeners? We have a special offer for you. Subscribe to DSR now at thedividendguyblog.com/deal to get a 15% lifetime discount. That means your membership will never increase. Again, thedividendguyblog.com/deal. See you soon during our next private webinar.
All right, so before I let you go, fun question here. What do you think you convinced me to get more excited about?
Well, you tell me, but I'll try something. So I think that in general, we complement each other pretty well. So I believe I'm good at enhancing your ideas and vice versa. You do the same for me. But one thing you threw at me and that you were really excited about was when you said, Vero, you need to work on our free newsletter and make it better. That was pretty much like the task. And then I revisited the design and the format, and it brought instant results. People got more involved, and we are getting new people on the free newsletter every day. And so you were very excited about that. And I know it's not directly linked with my portfolio and investing, but I mean, it's just I like the fact that more people are getting interested also by different growth stocks and empowering themselves with their finance.
And I can tell you that I am shocked that you were able to work on your own literally for like 7 years before I came into play, and that you treat this old company a little bit like it was yourself, like yours, and the fact that you spend so much time and energy, and then like whenever we got a meeting, like you always comes with your own idea. You have worked on those, and I mean, investors, I can tell you something. If you're still in the workforce and you're working like for someone or looking to get a new job or anything, there's a lot to learn about how Vero treats her job, where she treats it with a lot of heart and she comes in prepared. And I'm not easy to change my mind when I've made my mind on something, but you stand up and you're able to bring on some pretty solid points. So I'm always excited about the next project that we're going to work on, because I know that you're going to pour some fire into it and it's just going to be so much fun working with you. So Vero, thank you so much for answering all my tough and not so tough questions. I mean, we had a lot of fun. And if there's one thing that I want to highlight here is your transparency, where you disclose the good stuff, the less good stuff, but your willingness to learn quick. And whenever you made a mistake, and that is like a great sign that you are on for a great investing journey, you do not hesitate to acknowledge that mistake and then move on. So instead of like dragging onto those stocks forever, hoping they will recover, hoping that things will change, you just say, okay, you know what? That went wrong. I know why. Let's not repeat that mistake. Let's rebuild it and then move on. And by doing so, I feel that you have grown a lot in your confidence as being a DIY investor. So congrats to you, and thank you for being on the show today with me.
Well, thanks a lot, Mike, for all these kind words. Also, I was not expecting that, so I'm glad that you still enjoy working with me. And also, I also had lots of fun despite your tough questions. So, listeners, to understand why the dividend triangle is the foundation of my investment strategy and also the one we use at DSR, download the Dividend Income for Life guide at thedividendguideblog.com/income. I've mentioned DSR so many times this episode, I can't help mentioning dividendstocksrock.com. For the show notes and related content, visit thedividendguideblog.com/193. If you'd like to help me grow my baby, this show, hit pause and the subscribe button now. You might as well leave us a 5-star rating. Thank you for your continued support, listeners, and until next week, stay invested.
Hey, fellow investors, it's Mike here. I hope that you have enjoyed this episode. Please note that the Dividend Guide Blog podcast is at no time issuing buy or sell recommendation. Please do your own due diligence, as this podcast is recorded for information and hopefully fun purposes only. Make your research, make sure you do your stuff. We're not responsible for your losses or your profit after listening to this episode. And until next one, stay invested.